the Chief of the Financial Stability Analysis Division in the IMF. He's worked on financial assessment programs in many countries, including Turkey, and he's also worked on derivatives, OTC markets, and regulation of those markets. Today he's going to talk on importance of financial spillovers from emerging markets. So welcome there, nice of you to come, and the floor is all yours. Leave it to you to decide how you want to take the seminar, if you want questions in between or
Thanks very much, Errol, for very kind introduction, and good afternoon to you all. It's really a tremendous opportunity to be here to present and discuss with you all some of our recent work that we've been putting out on emerging markets at the IMF, and particularly on the rising impact of EMs globally. Our perspective, given that I am from the IMF, is inherently a global one. We try to take in most of our work a global perspective. It's our comparative advantage. And for that very reason, we find some of these interactions to be quite enriching for us, because typically on the other side, we have people from academia or from policy authorities who have a much more in-depth view of the countries that we go and talk to. So we find it, I hope, symbiotic. We certainly learn quite a lot by raising some of these issues and figuring out what more we can add. So for this reason, I would like to encourage perhaps as interactive a discussion as possible. Please feel absolutely free to interrupt at any time for any questions that you may have, or points you may want to raise, or suggestions that you may want to make. So let me spend some time on this slide, though there's no material on this, just to sort of motivate some of the discussion. When we think about the global economy, particularly about the global financial system, and how economic and policy developments in individual countries can have implications for asset prices and economies outside of their borders, perhaps the most natural place that most people start thinking about these things, about spillovers, is to think about what happens in the United States, given how large its presence is, both in economic terms, but also in terms of financial markets. So for example, it's natural to start thinking about what are the implications if the Fed were to tomorrow suddenly hike rates by a certain number of basis points, or were to suddenly reverse course and start reducing interest rates again. How is that going to affect the prices of risk assets locally, regionally, and even globally? After all, a rate rise in the United States, for example, which is not expected or not accounted for by markets, should be expected to lead to some degree of capital inflows and outflows from many countries, because we should expect banks and mutual funds to adjust their global portfolios in response to this. So what's true about cross-border spillovers from the United States is, to some degree, greater or lesser, also true, if upon some reflection, of some of the other major advanced economies. The euro area is an example, Japan perhaps less persuasively so, but perhaps the United Kingdom as well. Now, in this context, what about cross-border spillovers from emerging markets? Are they significant? How significant are they? Are they significant in other EMs? Are they significant regionally? Are they significant globally? For example, one can think, when one thinks about trying to address this question, one pretty much starts to think about what dimensions you would like to look at this question for. So one is, as I said, the geographic impact, which could be regional or global. So for example, if you think about Poland, which is an emerging market in Europe, it trades quite intensively, and its trading basket relative to GDP is quite large, but it trades mainly in a supply chain which is concentrated around Germany and involves mainly euro area trading partners. So one should expect that developments in Poland have some degree of cross-border implications, but one should expect that they should be regional in nature. Now as opposed to this, take the example of a country like China. Its trading basket is huge and it's quite global in nature. So we would expect that major developments in China should have some implications for economies and asset prices, not just regionally, but also globally. The other ramification is what types of markets should we expect emerging markets to have spillovers in or developments there. The nature of financial linkages is quite important when one starts thinking about this. Let me just give one example of the type of phenomenon that one can think about. Let's imagine that there is a major economic upheaval in Latin America, particularly, say, originating in Mexico or in Brazil. Should this have implications outside of LATAM? Spanish banks, BBVA and Santander, which are globally systemically important, have very large exposures relative to their overall business portfolio in these countries. So if they face major hits to their business in these countries, we should expect them to start delevering in a large number of markets in Europe and potentially even in their home country of Spain, which, given Spain's size in Europe, could then have knock-on implications for other countries in Europe and their asset prices. So again, just like trade, growing financial linkages could have surprising implications for how important emerging markets are and developments there are for countries which are even geographically quite remote through banking linkages. Now, in one sense, the question is almost moot. If you think about the impact of emerging market crisis, we can go back pretty far in the past to also talk about episodes where these could have had very large cross-border implications. The LATAM debt crisis could have had very big impact on losses in advanced economies, in US and in Europe, had there not been coordinated policy action from all of these countries to limit losses thereon. But our interest lies in looking beyond crisis and beyond a few countries of this sort. What we really want to talk about here is if you have normal business cycle shocks in emerging markets, which affects their own asset prices and their own financial markets, and triggers policy action by their central banks, should we expect this to have implications for asset prices beyond their borders? Just as we would think about there not being a crisis in the US, but merely the Fed hiking rates by 25 basis points and having an effect on the rest of the world. So that's really the question that we want to ask. So an archetypical example in this case would be this problem in Latin America, not necessarily in a crisis which goes through Spanish banks, affects Europe. Another example that one could think of, which is short-lived, is an episode that happened in China in January of last year, where there was a short, sharp crash in the stock market led to a shutdown in trading for a while, for a day or two, and this had very big implications for global risk asset prices all over the world in major stock exchanges. So it's these types of episodes that we are interested in trying to look at. So what provides the context, or what provided the context for this study is the changing role played by emerging economies on the global stage. Given the significantly higher contribution to global economic growth, their increasing centrality in global trade, and their growing participation in the global financial system, it is natural to hypothesize that the impact of asset price shocks and financial market volatility that in these countries on asset returns, not just in other EMs, but also in advanced economies, is now significantly higher than what it was in the past. Just to take the example of, start with the example of growth, EMs have contributed more than half of global growth consistently for the past 15 years, and their share of global GDP is now about close to 40% or slightly more. So they're pretty important in terms of their economic clout. In terms of trade between their trading portfolio and their centrality to global trade, what this chart depicts is how the trade baskets of AEs, advanced economies, and EMs have evolved over the last 2 decades. And what we can see is that the blue line was trade just among advanced economies. The red line is the trade between advanced economies and emerging markets. And starting from roughly less than half the level of intra-AE trade, EM to AE trade now exceeds significantly the level of trade between advanced economies. If one looks at trade, the green line just between emerging markets, this was almost negligible 2 decades ago. This is now roughly about half. This is on the right scale, the green chart, the green line. This is more than half of the blue line. So rising participation in global trade. So this data is, that's a good question. So our definition of emerging markets for this particular study was the way in which a market was defined by either a global stock market index like the MSCI or a global bond market index as an emerging market. Now, of course, the IMF in its own macro databases has its own definition of what constitutes an emerging market, which is driven often by the level of GDP. But this is based on a financial definition because ultimately we are interested in financial market spillovers that developments in emerging markets have. And therefore, a lot of the data that we use in this study is equity returns and bond returns and exchange rates. So we found it sensible to then define the world into AEs and EMs according to the way markets understand emerging markets and advanced economies. China would be an emerging market, India would be an emerging market. Southeast Asia, most of it except for Singapore would be an emerging market. Korea would be, so Korea is tricky. So there are a few tricky countries. Korea, Chile, the Czech Republic are tricky because the market considers these countries as emerging markets, whereas, so they're often placed in, when you look at MSCI, so stock mutual funds or equity mutual funds would, for their purposes of composing their asset portfolio, consider these to be emerging markets. So if they are an advanced economy stock fund, even global, undertaking an exposure to Korea would be moving outside that benchmark in a way, using their tactical leeway. But according to the IMF, for example, because of the level of the GDP, the Czech Republic, for example, is considered to be an advanced economy.
But financial markets consider them to be an emerging market.
How strong would this EM, between EM trade equal to remove China from the?
It would be significantly less. China is quite a large component of EM trade for two reasons. One is its own final goods trading portfolio is very large, but also there is a huge supply chain which is concentrated around China. So I wasn't planning to discuss this next chart, but essentially this chart gives you how much supply chains have basically become more important in the last 20 years. So what this chart really gives you is what's the ratio of the domestic value added of the globally traded portfolio of global trade in any given year to the value of global trade. So the lower is this ratio, the more are these inputs towards the final goods changing, crossing borders. So there's less value added at each step. So the value of global trade sort of inflates what is really traded in terms of final goods. The lower is this ratio, and therefore it sort of depicts what the importance of supply chains is. So effectively, China is very large part of this green line, and is also a pretty large part of this red line. From a trading perspective, China is very, very important. From this perspective, from financial integration perspective and financial flows and purely financial contagion potential of China, China is quite low. I'll come to these details later on. But just as I spoke about trade and the fact that the importance of EMs in trade has grown very significantly, and therefore their ability to affect foreign firms and their stock prices has become much, much more, because if I'm a foreign firm which has big exposures to an emerging market, a business cycle shock in an emerging market is likely to affect my stock price because it affects, for example, the demand for my products and services. So trade is one avenue through which China should be expected to affect the world a lot, but also emerging markets in general. The other is basically the growth in financial exposures of banks and mutual funds to EMs. So for example, bank exposures, advanced economy bank exposures to emerging markets, this red bar was about 2% of advanced economies GDP in 2005. It's jumped up to about 4% of that GDP in just 8 years. And in nominal terms, this is almost double the exposure in just about 8 years' time. And the growth in portfolio exposures, particularly via mutual funds, has been even more impressive over this period of time. What this means is that even if there is no direct trade or GDP linkage between two countries, an emerging market and an advanced economy, or two EMs, the scope for portfolio contagion or bank-based contagion between emerging markets and the rest of the world is much, much larger. So the example of the Spanish bank becomes quite important here, because if you have large portfolio losses in one country, in an emerging market, this can affect your ability to lend in all your markets. And it could mean that you delever and shrink in all your markets, which could mean that you have asset price knockdowns in many markets simultaneously. So then, put together, we can collate at this point a number of questions of interest. First and foremost, if we understand financial market spillovers from a country to mean the share of cross-border asset price or asset return volatility that originates in that given country, should we expect such type of cross-border financial market spillovers from emerging markets to have risen over the past 2 decades? If they have risen, how global is this evolution? Is it mainly a regional effect, or is there a global effect of shocks from EMs? And finally, in which markets, equities, bonds, foreign exchange, is this effect most evident when we look at spillover of shocks, spillover of volatility? So given the discussion that we've had so far, what we may hypothesize concretely is that the spillover channels have become more enhanced because, for example, financial markets are now much more integrated. Trade linkages of EMs are more extensive, and through supply chains, they are also deeper. So that if you have shocks in emerging markets, that these are triggers, you can expect their reverberations to be wider and stronger. So that we should expect the second question related to this, so we want to investigate this, but in addition to that, what we would like to do is, we've sort of proposed two channels. One is that you have real economic linkages through trade, and that's a linkage which lends itself most to shocks to fundamentals. So if your trigger is a shock to a fundamental, how is it that real economic shocks from emerging markets translate into asset prices abroad? And the second is basically what we call pure financial mechanisms or contagion. So you need not have a concrete economic linkage or a trade linkage between two economies. But the fact that you have common banks or common investors, mutual funds, between two countries, to what extent does that strengthen these types of shock spillovers from emerging markets? So the specific questions that we will address formally are, how have these spillovers evolved over time? What are the factors behind this evolution? What is the role played by trade and financial linkages? How do policy and institutional factors affect the behavior of the evolution of these spillovers? And how do country risk factors matter?
So I have a question.
Yeah.
So the way you are setting up the whole stage here, it seems like you are taking that the source in the less developed countries or the emerging markets of this disbalance is sort of to be the exogenous factor. Yes. Whereas this whole idea, and that's how you are treating it as an exogenous factor, and then you are saying how the spill. But the whole idea of this hot money flow and everything, the standard idea is exactly the other way around. That because there can be a contagion based on wrong information, blah blah blah. So investors all of a sudden pull out the money, which then causes an economic downturn in the host country, in the emerging market. So that I guess is the most standard story where this kind of cross-border portfolio allocation is more of acts as a source of the original downturn rather than being affected by the downturn.
So I would answer this question along two dimensions. The first one is that in some sense we have two different methodologies. When we estimate these financial market spillovers, and I'll come to this in the details of this slide, we use sort of this model of exogenous shocks and idiosyncratic shocks and how they spill over. Of course, the nature of the way in which contagion actually plays out can be purely some type of psychology. So you can get investors could be focused on a sunspot variable which has absolutely no correlation with anything in the real world. And if that sunspot switches, then they may, in a coordinated fashion, take a decision. But in reality, typically what happens even when you have such type of psychological contagion is that there is often some type of relevant trigger event which acts as a wake-up call. So for example, if you think about the Asian financial crisis of the late 90s, one interpretation of that is that trouble began first in Thailand, where investors realized that the local firms were over-leveraged and basically were weak in terms of credit quality. And at the same time, the banks and credit institutions which funded them had a serious liquidity and FX problem. And that might have made them think that the problem that they face in Thailand could be similar to the situation in Malaysia and Indonesia. So the shock did occur first in Thailand. It acted as a sort of a wake-up call. And of course, you could argue that then Indonesia could have escaped if investors didn't in a coordinated fashion react this way. In reality, of course, what is a trigger is then important as to whether in a particular example, the trigger happens to be something relevant and an idiosyncratic one in an emerging market as opposed to something very vague and so. But a less trivial interpretation of your question is you could have a shock in an advanced economy which tightens balance sheets of financial institutions. So let's say that you have a regulatory issuance out of the US or the euro area which increases liquidity or capital requirements. The banks suddenly find that they are overextended and they need to basically scale back their leverage. So the shock doesn't occur in an EM. It just so happens that there's a change in rules in their home markets. And then the market at large realizes, oh, these banks are going to move out. We better move out as well. So that basically kills the market in another country. So in reality, of course, the situation is more complicated. Okay, so in terms of the empirical strategy to address some of these questions, first we have a two-step approach in terms of both estimating the evolution of spillovers and then in attributing this evolution to a bunch of fundamental factors or drivers. So in this first stage, we estimate the evolution of what we call directional interdependence. So this is based on a vector autoregression model where essentially we have a bunch of endogenous variables which are asset returns in a bunch of countries. And we fit this into a VAR model. And then we use an identification strategy or an assumption in order to decompose the variation in asset returns in a given country, in a given market, and attribute that to basically variation in asset returns in not just in its own market, but also in other markets. So, and that is what we call basically a spillover of shocks in one asset market into another. That's a financial market spillover. At the second stage, we take these time-varying spillovers that we have estimated, and we throw that into a panel regression model where we put in some of these factors, evolving trade and financial linkages, evolving policy and institutional factors, and evolving country risks. and try to attribute this change in spillover to the changes in some of these fundamental drivers. Now, in order to dive deeper, as I said, what we are interested also is in to what degree have shocks to economic fundamentals and news about economic developments in emerging markets contributed to asset volatility abroad, as opposed to purely financial mechanisms or contagion. So we have two ancillary statistical approaches where we fit customized models to try to address and answer these questions, which are sort of related but separate formally from these exercises. Okay, so I'll sort of jog through this slide relatively quickly, and I'm happy to answer specific questions that you may have. So in terms of estimating directional interdependence, what we do is let's just take the example of equity market spillovers from EMs. What we do is to basically run a var-X model where the endogenous variables are local currency, daily, country level, equity market index returns covering 13 advanced economies and about 20 emerging markets. It's a var-X model because we also have a bunch of exogenous variables, global controls, and we put these in because what we want to do is when we talk about there being a spillover from one market to the other, we only want to look at the impact of idiosyncratic shocks. But of course, as we do know that there are certain global factors that affect markets simultaneously, so we need to purge the variation in these endogenous variables of these exogenous factors. So the Lehman crisis, for example, is a classic case of something that affected risk asset prices simultaneously all across the world. And that's the type of a factor that we want to sort of cut out when we run the regression. So in the results that I show you today, what we are going to focus on is basically regressions where we have just one global control, which is the option implied volatility of the US S&P 500 stock index, the so-called VIX. But we also have a bunch of other ancillary regressions, global controls, oil prices, commodity prices, global shadow rates, and others. The next issue with any VAR is basically how do we identify the VAR? We have about 33 endogenous variables. So you can pretty much bid bye-bye to Cholesky. You pretty much will not be able to get anything out of Blanchard-Qua type approaches. We can't use heteroscedasticity a la Ricobon, and sign restrictions also present similar problems. So what we really wanted to do is to have some degree of confidence that whatever variance decompositions we had were somehow order invariant in some way. So that's why what we ended up choosing in the end was this generalized variance decomposition approach of Koop, Pesaran, and Shin. It has its own bunch of problems. It's ultimately an identification strategy. So what it gives you is a measure of directional interdependence drawn from the data. What it won't give you is a sense of comfort about direction of causality, because the shocks have basically a non-orthogonal structure, unlike in a Cholesky framework. So basically then what we do with this is that we run rolling regressions covering 250 days, which is one trading year, over the period 1995, sorry, this is a mistake, it's 1995 through 2015, so that the spillovers that we derive are time varying. And these are basically the results. So this is a global picture of how the variation in equity returns on average globally have been driven by shocks originating outside of a country. So if we just focus on the blue line, the red line is foreign exchange, but in 1995, about 50% of the variation on average in equity returns in a given country in this sample was driven by shocks or equity price shocks occurring outside of this country's borders. This has risen to about 80% today. So globally, spillovers have risen, financial market spillovers or equity market spillovers have risen very significantly. And the same is true for foreign exchange markets. Bond market spillovers are more complicated. They have always been significant, but they are much more cyclical in nature. They don't show the trend increase that you see in equities and foreign exchange. What we are really interested in is these charts. These are basically the corresponding spillovers from emerging markets onto an average economy. So this is a spillover from how much of the equity and currency return variation in an average advanced economy in our sample is driven by asset return shocks in an emerging market. So what you can see is that the growth is very significant. On average, EM shocks used to explain less than 20% of advanced economy equity return variation in 1995. That's gone up by about 75% by the end of the sampling horizon. In foreign exchange markets, this is even more significant. It's gone up by about 3 times over the same period. And the same is the story in spillovers in these markets from emerging markets to other emerging markets. Yeah. Yeah. It would. The only way we can account for global tail events is basically by purging this thing of the VIX. So you'd expect the VIX to rise quite significantly if you have a tail event. Well, it's a bit tricky. So I think that we are reasonably confident that global tail events can be, so these results are purged of global tail events because we are controlling for it through the VIX. But you could argue, what about regional tail events? So that's something that we can't do. If we had focused on a particular region and run separate regressions, then we could have tried to add a regional control as well. So if you were to run this EM regression for Latin America, for example, then we could add some type of regional controls to.
And one more question, it's not about you, but the rival ilmas.
Yes.
Would they possible for that, did you somehow deepen it, or did you take out the unique groups, or you went ahead with
No, those are
those are very
yeah, those are
Your chart 3 and 4 are showing the impact both on average AEs as well as average EMs are very, very similar. Isn't it somewhat surprising?
Which ones are
Both 3 and 4, you see the charts, you see that the variation in both cases are structurally they are looking very similar.
They are remarkably similar, but they are similar in terms of the qualitative dynamics. They are not similar in terms of where the quantitative impact ends up. So, for example, this is about slightly more than a third is where the spillovers end up to advanced economies. This ends up at slightly above 40%. So intra-EM financial spillovers are now significantly larger, even though it's true they began at roughly the same levels. So.
What is happening during 97, 99?
Yeah, so the story here is that you have a crisis in Asia in 1997. So we would expect that spillovers do go up. This is a regional sort of a tail event. We don't control for this. So in this vector autoregression, you should expect these spillovers to spike during times when you have localized episodes in emerging markets, because you would expect that purely through the higher volatility, these would spill over to markets which are connected. So that's why you see a big jump in 1997, because you had a bunch of emerging market crises around that time. Mexico in 95, the AFC in 97 through 99, the Russian crisis in 98, and then Turkey in about 2000, 2001. If you look at what's happened around the Lehman event, there's hardly a spike in these things. Even here, you don't really have a spike during Lehman. That's because we are controlling and purging this index of the VIX. So, okay. skip this one, but one of the most, in my view, interesting results that we do obtain is that more than the size of the GDP of an emerging market, and even more interestingly, more than the size of its trading portfolio with the rest of the world, it appears that its financial integration of an emerging market that seems to be driving how large its financial market spillovers are. So if you think about all the emerging markets in the world, you would think that China should surely be the one which exerts the largest spillovers to the rest of the world. But that's where China is. Yes, its post-crisis financial spillovers are significantly larger than its pre-crisis ones, which are just a blip. But it's much smaller than emerging markets like Brazil, Mexico, Poland, Russia, and Chile and South Africa. So one thing that you will notice is that these are the two largest EMs in the world, India and China. They also are ones which have, through this sampling horizon, among the most segmented financial markets in the world. Whereas the Brazils and Mexicos and the South Africas of the world have traditionally had the least segmented financial markets. So it seems that basically more than size, more than trade, that it's basically how interlinked you are financially with the rest of the world that seems to matter, and how much spillovers you tend to exert. So when we have now an estimation of how these spillovers have evolved, the next thing we would like to do is basically to explain where this change is coming from, where this growth is coming from. And before we get to the results, what I would like to do is to maybe spend some time thinking about what the intuition could be, or what we may hypothesize. So the first thing we should look at if we think about spillovers, as we explained in the motivation, is how much has the trading portfolio and how much have the financial flows between EMs and the rest of the world grown. We would expect that the higher is the trade basket and the higher are the financial flows, and emerging markets should transmit more financial spillovers, and a country which has more trade and more open financial markets should also receive more financial spillovers. It's not easy to think about how similarity or differences in risk perception should affect spillovers. Remember, one thing that I have been agnostic about, or maybe this has been too subtle, is that I haven't spoken about negative spillovers or positive spillovers. So spillovers are, in that sense, we are agnostic about the direction of, or the normative content. So you could think about, let's just think about a fairly negative event in Brazil, which is a large emerging market in LATAM. If global banks and global mutual funds which are active in Brazil and Latin America decide that the events in Brazil give them a signal about what's going to happen to the rest of the region, because the region's economics are quite similar to Brazil, the market has a very similar risk perception of Brazil and Latin America. They could move out of all of these countries simultaneously. So similarity in risk perception could increase negative spillovers. But they have to rebalance somewhere. They may rebalance to the United States, where investors have a very different risk perception than Brazil. And that means the US is going to get a large positive spillover in terms of its asset prices and asset returns from problems in Brazil. So large similarities or large differences in country risk perception could both create a condition for large spillovers. This is a tricky one to handle from a regression point of view. If you have less segmented domestic financial markets, you should probably emit larger spillovers. We've already seen that in the previous chart. And you should also probably receive higher spillovers. If you have deeper domestic financial markets, larger financial markets, you may emit larger spillovers, but it also means that you have depth in your local financial markets to absorb shocks better. So you're probably going to receive less financial spillovers from abroad. If you have a major financial instability episodes, you should expect spillovers to be higher emitting and receiving. And finally, if you have weak corporates, then you may expect that you'll probably receive higher spillovers because the transmission potential of external shocks is higher because you are more vulnerable, your important sector is vulnerable. But you might also be in a position to transmit higher spillovers because the impact on your economy may be much larger.
I'm slightly unclear about the second point, this is similarity or difference in risk perception. So the example I gave is that there's a portfolio rebalancing. It might go from Latin American countries to US.
Yes.
But can't it be the other way around that from Latin American countries it goes to either India or China?
It could. It could.
So how are we sort of defining the similarity or differences in risk perception?
So that's a question about how we would measure country risk as perceived by the market. So in the regressions, where the independent variable which represents, so basically what we have is basically an absolute value of the difference between a country risk index between, let's say, to use your example, Brazil and India. So the absolute value would give you basically what is the difference in risk perception. We want to use absolute value because we believe that it's a similarity or difference rather than more or less that matters for spillovers. Because as I said, we are agnostic about whether the spillover is negative or positive. That's why the absolute value is what matters. So how do we construct it? We require an index of country risk. So we chose one publicly available measure of country risk. It's called the ICRG measure. So in the chapter that's been published in the Global Financial Stability Report, there's an Annex 2.1, where we have a table where these measures are defined. So you can, but this data is publicly
Yeah, just last one, if you can explain a little more about that corporate financial. I'm talking about only the leverage part, not the external borrowing, external exposure. Suppose a country like India, which last few years has seen increase in or huge increase in financial leverage, how that transmit to other countries? I'm just not following there.
So one way in which this depends on where the corporates are borrowing from. So we can have two types of examples. One is these are corporates which have large borrowings abroad. So so this could either be because global banks are lending to them directly, or
That part not from the borrowing side. Suppose the
yeah,
condition has drastically fallen.
correct. But so I'm trying to address that point. So the point is that there has to be some type of a link between, now the link could be direct or it could be indirect. Now if the corporate has high leverage, it means it's borrowing from somebody outside. It's not using its own internal funds. If it's borrowing from global banks or it's issuing corporate bonds in hard currency, then basically you either have banks or mutual funds in other countries which are exposed to your corporates. So if your economy takes a hit and your corporates suffer losses, some of these banks may face a hit on their own stock prices, or mutual funds may react by withdrawing from your financial system and moving into some other financial markets. Let's say they move out from India and invest in Brazil. Equity prices in India should fall when equity prices in Brazil should rise. So you would see this in terms of, if of course corporates are not levered, they are raising most of their financing from internal funds, then in some ways they might be worse off, but their transmission channel is clogged. They don't have any linkages to outside investors. Yeah, sure. Yeah. Okay, so this is a busy chart. So maybe I should focus on one set of bar charts and focus on that. So these are, what we have is, this is a regression where we took, let me just go back a little bit, where we took this blue line over here as the dependent variable and regressed it on some of these variables that I put up on this slide. So what we can see is that when you talk about equity market spillovers from emerging markets to advanced economies, the trade linkages, the significance of the emerging markets in global trade was and remains a very significant factor in propelling these spillovers. In the case of the equity return spillovers from emerging markets to other emerging markets, however, the role that is played by trade has fallen quite significantly. In quite great contrast to trade, when you look at the importance of corporate financial fundamentals, these have become very significant in driving spillovers in equity markets, both among emerging markets, but particularly from emerging markets to advanced economies. So when you think about, when you try to interpret this result from the perspective of a policymaker, yeah, so we are using, that's purely a sort of a rhetorical device in a sense. What we find it meaningful is that these are 2 decades, 1995 through. No, it's sort of more, we are trying to see what was, in a sense the crisis does have, we don't show it here, but the crisis does have a deep impact upon the level of spillovers. As an explanatory variable, when you throw in a GFC dummy, it does have an impact upon, it's statistically and economically significant. And it's not easily explainable in this regression because it's very coarse, but we also have a dummy for what we call, is this a period which is post-GFC, which is post-Lehman in a sense. That's significant as well. So what we sort of think, when we try to interpret these results, what we think is that if you think about what happened after the crisis was followed by a period of extraordinarily accommodative monetary policy in most of the major advanced economies. And what this led to is a lot of mutual fund flows from advanced economies to emerging markets. So we find that this is sort of a structural change in the nature of portfolio flows. Banks were much more active before the crisis. Mutual funds are a lot more active after the crisis. The liquidity implications for capital flows are quite different. And that is also linked to, because corporates have been able to issue in many emerging markets lots of hard currency and local currency debt, which has been bought by mutual funds.
But the main change is the red one, right?
So here, the main change is the corporate financials.
The black one.
But it depends. So what is the black one?
Green.
Yeah. So let me just. It's green.
So that black is actually green.
The black is green.
Green
Yes.
is what?
The green is market integration. Okay, so let me run through.
Red is corporate finance.
No, red is differences in country risk perception. Yeah. Okay. So as I said, this is a busy chart. Maybe I should just run through them sequentially. They didn't, yeah. No, not in these regressions, we don't. We found it easier to, when we looked at pure contagion mechanisms and we looked at mutual fund behavior, that's where we found it more useful to try to make some of these decisions. But here it was more meaningful to just separate the things into pre and post Lehman in a way. So corporate financial, as I said, have become significantly more important. It's not that market segmentation is not important after the crisis. It still is quite a large contributor to the magnitude of spillovers. in both EMs to AEs and EMs to EMs. But while this, if you look at some of the more comprehensive studies of how and when have emerging markets reduced market segmentation, what you find, these papers by Bickert and others, what you typically find is that most of the action on capital account liberalization and other things happened during the 1990s and up to about 2005. So these indexes of market integration, or financial market integration, tend to rise quite steeply up to about 2005, and then they flatten out thereafter. So in some sense, this may be an artifact of the fact that there is a lot more variation in this, explanatory variable before the GFC and a lot less afterward. So most of the action on the right-hand side is happening before the crisis.
Yeah. Which of these factors will be affecting the strongest for the excess liquidity?
Pardon me?
Which of these factors will be affecting the strongest because of the excess liquidity due to all the QE being done by various central banks? You would argue that some of these factors will diminish because of the excess liquidity that's there in the market itself.
So it really depends on when within the QE era you sort of try to look at this. Almost certainly corporates, particularly in emerging markets, would be increasing their leverage because you have easy financial conditions. So corporate financials are going to change quite a bit, because part of this is really a vector which includes leverage of corporates, reliance on external financing, and corporate liquidity and corporate profitability. So in some sense, during QE, there is a lot of action here, on the right-hand side. But also here, so for example, if you break up the QE period into pre-taper tantrum and post-taper tantrum, there's a lot of action going on. There's a lot of volatility in this series over here because country risk perceptions changing quite wildly depending upon.
You also expect the green to shrink, right?
The green one here?
That should be expected to shrink, right? If liquidity, there's an excess liquidity in.
But this is market segmentation. So this is really a structure, this is a much more slower moving variable, because what it's composed of is legal decisions like opening up your capital account, which is a de jure measure of market integration, and corporate disclosures and corporate transparency and corporate governance, which may de facto lead to, if you have improvements in this, it might encourage foreign players to invest in your markets. So, but these are likely to be very slow moving variables. So there's not much interaction between QE and this variable over here. Okay. Maybe I should move on. Okay. So if there are no more questions on this, let me sort of move further along. As I said, one thing that we are interested in making a deeper dive in is looking at what's been the impact in making for higher spillovers of shocks to economic fundamentals. So how much of this growth in spillovers is just the fact that economic shocks in these countries are having a larger effect, and how much of it is related to purely financial contagion. So let's tackle the issue of economic surprises in emerging markets and equity and bond returns in other countries first. There are a number of reasons why it's important to answer this question, apart from this issue about trying to decompose where this is coming from, economics or contagion. I can think of three. First is a methodological one. Remember that the results in the preceding exercises are based on VARs, and VARs are just one way to interpret the data, and they come at a big cost because you're putting in an identification restriction. So, moreover, the identification restriction we have in place doesn't give you a clean sense of direction of causality. It talks about direction of interdependence. So, if you think about this regression where we are basically looking at, this is a factor model of equity returns, where we are regressing the return daily. This is an event study where these are daily returns in the equity market in any given country in our sample, regressed on economic surprises in emerging markets. That's why you have a different index here, which is J. Global shocks to purge the surprises of global events, and a laggard dependent variable. So this is much cleaner in terms of giving you a clean sense of direction of causality. Second, in the VAR, you're mixing two things. You're mixing financial frictions and contagion, and you're mixing economic fundamentals, and there's no way to decompose what's the effect of either. So again, methodologically, this regression is a cleaner way to sort of rule out financial frictions and talk about the effect just of fundamental shocks. The last thing is a little bit more subtle, which is, and let me use the example of China to sort of convey what the problem with the previous approach is. China has a very segmented financial market, but there are a lot of Chinese firms which are listed on its onshore market, the A-shares market, and the Hang Seng Index, the Hong Kong offshore H-share market. You often have the same equity share, it has the same properties. It pays exactly the same dividends, and basically if you were to sell it, it pays you exactly the same return. It's supposed to, because it has the same properties. Yet, the price dynamics of these two series of stocks of these identical firms are very different when you see them in the A-shares market and when you see that in the H-shares market. Now, why is this relevant to to motivating this regression? Basically, the reason why we believe this happens is because of two reasons. The A-shares market has virtually zero participation by foreign investors. The H-shares market is dominated by global investors. The A-shares by retail Chinese investors. The H-shares market has a very actively traded derivatives and options portfolio accompanying the Chinese shares of the listed firms. The A-shares market has virtually no hedging and no arbitrage for much of the sampling horizon. So basic finance theory informs us that you should expect the volatility properties in these two markets, even for the same firms, to be very different, which is what the data actually tells us. What we suspect, therefore, is that for the case of countries like China, India could very well be another example. Because on the VAR, we use the A-shares index, because it's representative of the Chinese equity market, much more than the H-shares. The VAR is probably understating the magnitude of spillovers from China. So by looking at economic surprises, if they are appropriately constructed and structured, we can circumvent this problem that the A-shares market is, for example, quite segmented. So just to sort of go a little bit more into this regression, we have only 3 emerging markets for which we have meaningful surprise measures. Actually, there are 5, consistently over the sampling horizon 1995 through 2015. India is not one of them. So this regression we ran, the J's in this index were China, Brazil, Russia, Mexico, and Turkey. These are the 5 major emerging markets for which we have surprise measures. And then this is the rest of the sample, basically. One final note, what is the surprise? The surprise is a continuous variable, and it has only one dimension, which is that these are growth surprises which are captured by the deviation of realizations of industrial production relative to the consensus forecast. So that's why this is an event study, because the only dates in this regression are the dates at which the IPI was refreshed and then compared to the consensus forecast, and this is the difference between the two of them. So a positive surprise is when the IPI index turns out to be larger than the consensus forecast. So that's a positive growth surprise. And a negative growth surprise is when the realization of IPI is less than the consensus forecast. The results are actually quite striking. We have only 2 countries for which we have somewhat significant results, or results where there is an increasing trend and where at the end you have economically and statistically significant impact of shocks to fundamentals on other countries' equity returns. And even here, China is special. So this chart is basically the impact of a surprise in Chinese growth announced to the world on equity returns globally on average to the rest of the world. This trend, if you pull it back to the 90s, is consistently increasing. So the first thing you note is that China and Brazil have an increasing trend. Globally, the impact of Chinese shocks becomes significant close to after the Lehman event. And they are globally more significant than regionally. This is quite important because that means that the impact of China is not just regional, on regional financial markets. It's in fact a global one, and China exerts a much greater impact on equity returns outside of its region. Brazil, on the other hand, does not have a significant impact on global equity returns. But towards the tail end, it starts to have a statistically significant impact on regional equity returns. So in some sense, this rescues China. If you thought that China should be very important, it is, but not because it has integrated financial markets, and not because its asset price shocks onshore is having a big spillover onto asset prices outside. It's basically through the growth channel. It's not sort of captured in a clean transmission from Chinese growth to Chinese asset prices to foreign asset prices. So it's not a financial market spillover in a conventional sense of the word. Not in this study. In this regression, it's included. Of course, you don't see it. It's the almost invisible. It's the, I don't know if you can see it here. It's the gray bar over here. That's direct financial linkages, FDI and portfolio flows relative to the GDP of a. So we do incorporate in that.
Just earlier chart. This is 95% confidence interval.
Yes, actually it's a 90%.
90%. So, except you that number 2 chart, in most places these are all insignificant, except in the last one. 2015 only is looking significant. Because everywhere I see that 0 is included in CR.
You are right. In a sense, the Brazil result is quite weak.
Yes.
We put it up primarily because you see a consistently increasing central trend, and you see some significance at the very tail. Again, I wouldn't emphasize this result too much, but merely to note that there is some evidence of a nascent regional effect of economic shocks in Brazil, but not a global one. But the Chinese one is striking because the global impact is the one. It's not so much a regional impact as a global one. Actually, yeah. It's because of time differences, what we do is to average over 2 days daily equity returns.
And the shocks, of course, say production figure shocks will be happening, what, 3-4 times a year?
They happen
depending on how frequently they are announced.
Around some countries it's quarterly. We choose the lowest frequency at which it's available.
So then T for, so the return would be for the
The
day
IPR
on which the IPR is announced?
Sorry, for most of these 5 countries, the IPR is monthly, not quarterly.
So the return would be the day on which the IPR is announced only.
Yeah.
So there would be 12 observations for that time.
Well, but this is a 20-year.
Yeah. So I'm saying
so 20 times
in a
12.
year there would be 12
That's right.
return figures and 12.
That's correct. Yeah.
And why industrial production? Why not anything else? Why not surprise in anything else?
Okay, this is a good point. So let me make another pitch about why these results are especially strong, and sort of try to answer this question. We had access to sort of a market indicator. UBS and Citi both have, Citi or HSBC, both have market-based indicators of shocks to fundamentals or economic surprises, market surprise indexes. The problem with those indexes that we find is that they don't give you a measure of the intensity of the surprise. So for example, if you have an enormously positive event, like let's just focus on growth surprises. Let's say that the surprise measure is 2 percentage points as opposed to 20 basis points. You would expect that the 2% should have a much stronger impact on equity returns than 20 basis points. It is much larger and more intense. So typically these market-based surprise indicators don't have any, they only tell you whether the surprise was positive or negative. They don't tell you how intense it was. So that's one reason why in the end we decided to go with something which clearly is associated with growth, but is a continuous variable that gives you an index of intensity. But I think you make a good point about why just IPI and why not other dimensions. Because after all, if you think about China, growth surprises should have an impact on equity returns outside. Major policy changes should also have an impact on returns outside, particularly if they are unanticipated. And political events in major emerging markets should certainly have an impact. So in some sense, these are fairly strong results because in a way, we don't have a strong or an encompassing measure of surprises here. It's a fairly narrow measure of surprise. So in that context, this result is especially strong. And maybe there is a way to sort of be more generous in sort of thinking about this result too. There's another thing which I should point out at this stage, which is that we treat these things as exogenous. The VIX is more or less exogenous to developments in every other country but the US. So it's a genuinely global factor in that sense. But things like oil and commodity prices, which we also have in this vector G, there's evidence by now that shocks in large emerging markets are affecting oil prices and are certainly affecting metals prices, China and Brazil, for example. So in some sense, we may be attributing some of what belongs here to this variable over here. So, but that's a modeling choice at the end of the day. Okay. Oops. Sorry. Yes. Okay. All right. So finally, let's take a look at the implications of the increasing role played by mutual funds in intermediating capital flows, particularly after the crisis, on the portfolio channel of contagion from EMs. Now, unlike most of the exercises that we discussed earlier today, this one we require actually a theoretical model. Of course, when we typically do these exercises in real time, we have no time to derive any theory ourselves. So we have to borrow, but what we really want is a model of mutual fund behavior in response to shocks. So what we wanted was a sort of a clean and neat theory where if a mutual fund, which is active in multiple markets, is affected by a shock in one market, which exerts a major loss or a gain, how will this affect its portfolio allocation to all the other markets in which it is active? Because in some ways, contagion is all about you have a shock somewhere and then you respond in many other places which are not necessarily economically interlinked to this one place where the shock originates. So what we did was basically to use a model published in a paper by Bronner, Helos, and Reinhardt in JIE of 2006. And basically what they have is a model where you have either global equity funds or global bond funds, which are active in many countries. And what they do is that if you have data which sort of shows you whether a particular fund is overexposed to a market, either relative to its benchmark or relative to its peers, then they hypothesized that basically if it suffers a loss in such a market, it would retrench back to its index or retrench back to its peers. And that it would do so not just in this market, but in all markets where they are overexposed. So why is this important? This is important for our study for the following reasons. In a sense, what happened after the GFC, particularly when the ECB, the Bank of England, the Bank of Japan, and the Fed in particular embarked on very accommodative monetary policy and QE. It created the perfect conditions for bond funds in particular to borrow from these markets and to park money in emerging markets. So often these were global funds, and they were basically going far beyond what their index weights were. So they were overexposing themselves relative to their index to a large set of emerging markets. So this model of Bronner, Hellos, and Reinhardt was quite suitable for our purposes, because in a way what that theory does is to tell you when you get a shock in a market you're overexposed to, how do you respond in all other markets where you're overexposed to. And that's really what we wanted to sort of look at over here. So so what we do is, this is a factor model of equity and bond returns, which is entirely driven by exposures that this country I, in which the return that we are trying to model exists, is linked to other countries in your sample. So for example, so this is a contagion model of asset returns in a way, pure contagion model. What's country I's trading exposure to country J? That should, so if you have a shock in J, their trade relationship should affect asset returns. What's the size of the financial market in country J, the bond market cap or the equity market cap? The larger is the size, the more in general should be its contagion potential to other markets. And finally, this common investor channel is modeled through what we call the financial interdependence between markets in country I and country J. So how do we measure that? You take all mutual funds which are overexposed to this country J, which is the shock transmitter in a way, and you look at what's the dependence, what is the share of the market cap in country I which is held by these mutual funds. And we call that the degree of interdependence of country I's market on mutual funds which are overexposed to country J. That's financial interdependence in a way. It's very convoluted, but that's basically what it is, because that sort of gives you a measure of contagion through common investors in the theory. Before we go to the results, let me just show you what's been happening in terms of financial interdependence on emerging markets in our sample. If you look at global equity markets, what you find is that the financial interdependence that emerging markets have on each other in the equity market side has risen very steeply over the last 10 years. And so has been the case for advanced economies since the GFC in particular. So if one believes that this mutual fund channel is a powerful channel of contagion, then in some sense what this tells you is that on the equity market side, the presence of common mutual fund investors has increased this contagion potential quite a lot. When we look at the bond market side, there's not much in terms of action between the interdependence of AEs on EMs. This may have something to do with the fact that bond markets in advanced economies are significantly larger than bond markets in emerging markets, and therefore the amount of bond market cap that's held by these investors may be active in EMs may be small. So that's why you don't see much over here. But after QE and after the GFC, this has basically shot through the roof. That's because you have the same set of players basically becoming overexposed to all the emerging markets in our sample. So that's the attribution analysis from the regression that we have. We should expect that the story being so potent on the equity side, the explanatory power of financial interdependence should grow quite considerably, and that's exactly what has happened. On the bond market side, economically things are still insignificant, and that might have to do with the fact that EM bond markets are still very small. But what the chart doesn't sort of show you, but the regressions would, is that the statistically financial interdependence has become very significant statistically in driving bond returns. especially in emerging markets. So let me not go through the main findings again. Let me just sort of talk a little bit about what would be the sort of takeaways from policymakers from studies such as this one. So first, at a global level, taking account of economic and policy developments in emerging markets is clearly important for most countries now in terms of assessing their own macro financial conditions. Failure to do so would basically mean that you're ignoring important factors that impinge upon your own financial stability, not particularly sensible for policymaking. The second implication is that given that the portfolio channel of contagion has been strengthened by the growing presence of mutual funds as common investors, particularly among emerging markets, there is an urgent need to plug the significantly large data gaps that exist in terms of the portfolios and positions and risks that these funds are undertaking. Because if you don't have an idea of how these things are evolving, and we have a much lesser idea of mutual fund activity than we have of banks, you can't design stability policy around these risks in a coherent fashion. The third is basically that we have clear-cut evidence statistically that not only are weak corporate financials a source of financial instability at home, but they are also a source of stability spillovers to countries outside. So there may be considerable merit in thinking about developing macroprudential tools to limit excessive leverage either through banks or through financial markets for these. Second, for EMs as a whole, how would you attenuate? Is there any way policy can help in attenuating financial spillovers from outside? As with many other studies, we'll basically flog a well-known horse and hope that something can be done, which is that one piece of analysis that result that we do have is that developing a large and strong, deep local investor base does help you in attenuating shocks much better. So whatever countries can do to develop their local financial markets and whatever policy can do will help them be resilient in the face of exogenous shocks. Finally, China. Among emerging markets, the impact of developments in China on global asset markets are notably larger. Of course, we are not seeing this through financial markets, but we are seeing this in terms of the impact of shocks in China on asset markets abroad. But this does give us some pause for reflection. China is probably going to open up its markets to foreign investors at some point of time in the next 10 to 15 years. It's also at that time going to allow its domestic investors to acquire a global asset portfolio. Once this happens, you can expect these financial spillovers to increase much, much more. So not only from a domestic point of view, but from a global standpoint, I think it's becoming more and more important for China to have clear and timely communication of its policy decisions, and also transparency about its policy goals and adoption of strategies that are consistent with achieving these policy goals. So let me just stop here for any further questions or points or suggestions that you might have.
So in your mutual fund study, do you include hedge funds also, or is it just
No, it's just bond.
pure
It's basically global equity funds, global bond funds. I think that's basically the universe that we have.
I was wondering, the way the mutual fund managers are assessed in a non-only fund is relative to the benchmark.
Yes.
Whereas for a hedge fund,
It's different.
It's different.
So we don't have hedge funds in there.
Right, but the exposure of hedge funds are also significantly large.
They
I
are.
was just wondering that maybe if the juxtaposition of both these two different international fund classes could perhaps make your study more.
So it could be the case that if you add hedge funds, this could result in more, depends on what type of funds these are and what type of strategy they have. If they are sort of macro hedge funds which are not necessarily wedded to a set of markets, or where they basically select country weights depending upon macro conditions. This could increase contagion. If these are dedicated hedge funds which take a long-term view of a country, these could add some stability and reduce the portfolio channel of contagion. So it really depends on, but I think this brings me to an important point. Even mutual fund data is very incomplete. So in a sense, there is a very large universe of global mutual funds, both on the bond side and on the equity side. And what we really wanted was, for our regression, we wanted basically precise exposure amounts that they have to each country in our sample. This is fairly, from a mutual fund standpoint, this is fairly granular data. And we have information at this type of level for about 800 to 900 funds. So from a statistical point of view, this is a representative sample, but it's very small relative to even the universe of global mutual funds. So statistically, this analysis is fine. From an economic standpoint, there's a very large data gap. So that's one of the reasons why we have this policy recommendation.
There is one more thing came to my mind is that there are certain indices in emerging markets which are very narrow. So they're very top heavy.
Yeah.
Just a few firms,
Yes.
commodity run countries or commodity heavy countries, where the top few companies would be a large market cap of the entire industry. And they're usually these companies are very well covered internationally.
Yeah.
The analyst coverage of these companies. Maybe the contagion effect of these countries is perhaps significantly different from more diversified economies.
I think that's a legitimate point. In a way, we have to live with basically what the data are in terms of constructing the indices. The only measure of comfort that we can draw is that for all the countries that we do have, they also have, so we ran these regressions, the VAR and the panel regression trying to explain the VAR at two levels. So we ran them at the level of each country's stock index, but then we also ran them at the level of 7 sector level stock indexes. And the reason why we were able to do so is that we have sector level stock index data for these 33 countries. And then when we look at the explanatory variables in the panel regression, we also have sort of a matrix of intrasectoral and intersectoral trade. And that sort of helps us run a sector level panel regression at the second stage. But at a country level, I think your point is well taken. Yes.
As I understand, suppose you weight these regressions by country size.
Yes. Which regression?
All these,
Panel regression.
Yes. Would it change? Is China driving a lot of?
How would you weigh them?
By economic size.
So I can see some. So I think this depends on your. This is my personal view is that this depends on your perspective. So if you're trying to explain the VAR, I wouldn't want to go with economic size, because in a sense, what does the VAR do? It talks about how much of the variation in Brazil's equity returns can be explained by the variation in Chinese equity returns. If China has a very segmented equity market, which has all sorts of pricing anomalies, which we know it does, in a way, by weighing by weighing countries by economic size, you are overinflating sort of the asset price channel of financial market spillover. I think size becomes more important when you're talking about the impact of economic shocks directly on asset prices abroad, not through your asset market. So it depends. Statistically, I think the notion of financial market spillover is closer to what we have in the VAR, because in a sense that's asset price to asset price, asset market to asset market. And then it also allows us to capture both the impact of economic fundamentals, but then also allows us to capture this contagion channel, because the contagion channel really operates on asset price to asset price in a way. So that's why in the VAR we want to have this measure of financial spillover, but then we don't want to weigh it by economic size because there are these pricing anomalies associated with market segmentation.
Just trying to extend that argument further. So instead of size, maybe you could look at free float of the equity market. That might be a better indicator.
Yeah, so we did include that as an alternative when we. I have to go back and I would have to go back and confirm, but I believe that when we looked at market size, we used two measures. One is basically the total market cap and the float part of the market cap. So there we are trying to be sensitive to, the traded value of the equity or the bonds.
Just to be sure that you're finding that financial dependence integration seems to have increased after the financial crisis.
No, in fact, what I said was that this is not our study. In a sense, the most comprehensive studies are by Geeth Beckert and his co-authors. And what they did was to basically run through many methodologies of trying to look at what has been the progression of integration, particularly of emerging markets into the global financial system, very broadly. And what they have a bunch of measures. Some of them are de jure, which is changes to capital account openness through legal measures.
No, but in terms of looking at from this
perspective, I see. So what we find in the attribution analysis is that market segmentation or changes in market segmentation are quite significant in terms of driving spillovers both before and after the crisis. But they are less significant after the crisis. And the reason for that is because the variation in the time series of the index of market integration is lower after the crisis. Because most of the action de jure and de facto tended to occur before 2005. Sorry, there was a question.
Yeah, I think I was, just help me clarify what I'm thinking. There's growing financial independence.
Yeah.
Is there also growing trading independence, like trading in terms of real?
Yes, I would say so because rather than just trading final products manufactured in countries, most trading is now organized along regional or global supply chains. So there is a very large regional supply chain concentrated in Europe around Germany, which involves a lot of advanced and emerging market Europe. And then there are big regional and global supply chains concentrated around China. So that means that a lot of countries are swept into, so that's why not only has just the value of trade that emerging markets do grown so significantly, but in fact the round tripping of trade before a final good gets produced and traded has increased very significantly. Thank you very much.